John and Carla started investing the exact same year. Same age, 42, same $50,000 to put to work. John picked the fund with the fat yield, 3.4% paid out like a paycheck. Carla picked the boring one instead, a plain S&P 500 index fund yielding barely 1%. John actually laughed at her choice. 1%? That's nothing. I'm getting paid 3 times that. Carla just shrugged and kept buying every month. 10 years later, the two of them compared accounts. John was genuinely stunned by what he saw. He had chased the bigger yield the entire decade. He had collected more dividend cash every single year. And somehow, Carla still ended up with more money. Not a little more, tens of thousands of dollars more. They both believed they made the smarter choice. And here's the strange part. They're both wrong about why. Because the yield John chased was never the thing that mattered. And the boring fund Carla bought was never actually boring. It was quietly doing the one thing that builds real wealth. This is high-yield funds versus boring index funds. No hype, no guru sales pitch, no shame. Just the real uncomfortable math behind which one actually makes you richer. And by the end, you will know exactly which mistake you are making right now. Here is why this matters more than almost any other money decision you make. The fund you pick today will compound for 30 or 40 years. A gap of just 2% a year sounds tiny and harmless. Over a lifetime, that 2% quietly becomes a 6-figure hole. We are talking about the difference between retiring at 60 and retiring at 70, and most people pick their fund for one reason only. They look at the yield number and they chase it. The bigger the yield, the smarter they feel. It looks like free money landing in the account. It feels like winning every single quarter. But the yield is the one number that fools almost everyone. Because a fund paying you 3% can still lose to a fund paying you 1%. That sentence breaks people's brains, so let me say it again. A higher yield does not mean more money in your pocket. Sometimes the higher yield is a warning light, not a reward. Sometimes it quietly hands a chunk of your returns straight to the tax man. And sometimes the fund handing you income is just selling you back your own money. Most people never run these numbers in their entire life. They just feel the dividend hit the account and assume they won. By the time the real gap shows up, 10 years are already gone. And you can't get those 10 compounding years back. So let's keep this fair. We are going to give both funds their best possible case. Let me introduce you to both investors properly, because the setup is everything here. John is 42, a project manager earning $92,000 a year. He is responsible, he saves, and he is not reckless at all. John wanted his portfolio to feel like it was actually working. He wanted to see cash show up, real money he could point to. So John put his $50,000 into a high-yield dividend fund. Think of a fund like SCHD or VYM, the kind built to pay you. At the time, his fund yielded about 3.4%. That meant roughly $1,700 a year in dividends. To John, that number felt like undeniable proof. Proof that the money was alive and doing its job. Now meet Carla. Carla is also 42, a coworker earning almost the same income. Carla did not care about feeling anything from her portfolio. She bought a plain S&P 500 index fund, something like VOO. Her fund yielded about 1% at the time. That was barely $500 a year in dividends. John out-earned her on income from day one. 3 times the dividend cash, every single year, guaranteed. If this were a contest of yield, John wins in a landslide. And for the first couple of years, John honestly felt like a genius. His dividends grew. He reinvested them. The account felt productive and alive. Carla's fund just sat there quietly, paying almost nothing. She barely even looked at it honestly. She kept buying the same boring fund on autopilot. No excitement, no paycheck feeling, no bragging rights at all. Now there's a third person worth mentioning here, Maya. Maya was so scared of picking wrong she never invested. She left her $50,000 sitting in a savings account. 10 years later, inflation had quietly eaten most of its value. Doing nothing turned out to be the most expensive choice. So at least John and Carla were both in the game. Both of them invested the same $50,000. Both reinvested every dividend they received without skipping. Both held on through every scary headline for 10 full years. Neither one panicked and sold at the bottom. This is the fairest possible comparison you can build. Same money, same discipline, same decade in the market. The only difference between them is the fund they chose. One chased the high yield. One accepted the boring one. So now we do the only thing that actually settles this. We stop guessing and we finally run the numbers. Because the dividend John saw was only half the story. The other half is the part nobody ever puts on a thumbnail. Here's what nobody tells you about yield. Yield is not your return. Read that twice, slowly. Yield is just the slice of return paid to you as cash. Total return is the number that actually matters in the end. Total return is the dividend plus the growth in the share price combined. John fixated on the dividend and ignored the share price entirely. That is the exact mistake that quietly cost him the decade. He saw the cash arrive and assumed that was his profit. But the cash was never the whole picture. Not even close. A fund can pay you 4% and grow only 6%. Another can pay you 1% and grow 14%. The second fund makes you far richer despite the smaller paycheck. Over the last 10 years, the boring S&P 500 fund returned about 15.5% per year. The high-yield dividend fund returned closer to 12.5%. That 3% yearly gap is the whole ballgame right there. John's fund paid him more cash but grew far slower. Carla's fund paid almost nothing but grew much faster. And growth, it turns out, is where the real money actually hides. The decade that settled it. Let's turn those percentages into actual dollars now. Numbers feel abstract until you see them as real money. Carla put $100,000 into the boring index fund. Over the decade, that grew to roughly $339,000. John put the same $100,000 into the high-yield fund. His grew to roughly $310,000 instead. That is a gap of about $29,000. $29,000 on a single $100,000 starting point. And remember, John collected far more dividends the entire time. He still finished tens of thousands of dollars behind her. Let that sink in for just a second. He got paid more and ended up with less. Now scale that up to a real retirement-size portfolio. On $500,000 invested, that same gap becomes around $145,000. The income fund quietly cost him a small house deposit, all because he chased the number that simply felt good. That is what a few percent does over a decade. Now imagine stretching it across 30 years instead of 10. The reinvestment illusion. Here is a trap inside the trap. John reinvested every dividend, just like Carla reinvested her growth. So he assumed they were on completely equal footing, but there's a hidden leak in John's plan. In a taxable account, he paid tax before reinvesting, so every dividend was shrunk by the taxman first. Then whatever survived got reinvested into more shares. Carla's growth compounded untouched, with no yearly tax bite. John's dividends compounded after a yearly haircut every single time. Same idea, reinvesting, but one had a leak and one didn't. Over a decade, that small yearly leak compounds into a real loss. The reinvestment looked identical, but the math underneath was not. Here's the part that actually stings. Taxes. This is where the high-yield fund does its quietest damage. Every dividend John received was a taxable event. Every single year, whether he wanted the cash or not. In a regular taxable account, that tax bill is forced on you. John owed taxes on $1,700+ every year. Then more and more as those dividends grew over time. Carla's fund paid almost nothing in dividends, so she owed almost nothing. Her gains stayed locked safely inside the share price untouched. And here's the quiet magic of that arrangement. You do not pay tax on growth until you actually sell. Carla controlled exactly when her tax bill came due. She could wait decades or sell in a low-income year. John's tax bill arrived every April whether he liked it or not. He never got to choose the timing at all. That is called tax drag, and it is brutal over decades. The high-yield investor is taxed on money he never chose to take out. The index investor defers taxes for 30 years if she wants. Same market, same discipline, wildly different tax bills at the end. And the higher your income, the worse that drag becomes. Dividends were never free money. This is the single belief that fools almost everyone. When a fund pays a dividend, the share price drops by that exact amount. If your share is worth $100 and pays $3, it becomes $97. This is not a theory. It happens automatically on the ex-dividend date. The dividend did not appear from nowhere like a gift. It came directly out of your own share value. You did not get richer the moment the dividend hit. You just moved money from one pocket to another pocket. The market literally subtracts the dividend from the price on payout day. So that paycheck John loved was partly just his own money handed back. And then, cruelly, he got taxed on receiving his own money. Read that again, because it is the whole entire trap. A dividend is a withdrawal the fund makes for you, automatically. You did not ask for it, but you pay tax on it anyway. With an index fund, you choose if and when to withdraw instead. That choice, it turns out, is worth a fortune. The homemade dividend nobody talks about. Here is what Carla could do that John simply could not. If Carla ever wanted income, she could just sell a few shares. That is called a homemade dividend, and it is quietly powerful. She controls the exact amount and the exact timing herself. Want 3% this year? Sell 3% of shares. Want nothing this year? then sell nothing and pay no tax. She only pays tax on the small gain inside those shares, not on the full amount, just the profit portion of it. John, meanwhile, got taxed on the entire dividend every single year. He had no say, no off switch, no flexibility at all. So Carla could create her own 3% income anytime she wanted. With more control, more flexibility, and a far smaller tax bill, the high-yield fund took away her choice and called it a feature. Most people never realized they were actually paying for a downgrade. They thought the forced paycheck was a perk. It was really a loss of control in disguise, the value trap nobody warns you about. Now let's talk about why some yields get so high. A yield goes up for two very different reasons. Either the company raised its dividend, which is genuinely good, or the share price collapsed, which is very bad. When a stock crashes hard, its yield mechanically shoots up. A falling stock can suddenly look like a 9% yield. New investors rush in chasing that big fat number. They think they are buying income at a discount. They are really buying a sinking ship with a shiny flag. That is called a value trap, and it is everywhere in high-yield land. The highest yields on the screen are often the most dangerous ones. The fund looks generous, but it is really just wounded. Then the company cuts the dividend, and the price falls further. Now the investor has less income and less capital. Chasing the biggest yield often means buying the weakest companies. The boring index fund never falls for this trick. It just owns the whole market and lets the winners run. It quietly drops the losers and keeps the champions. No emotion, no chasing, no value traps to step on. What about high-yield bonds? Let's be fair and check the bond side too. Some people hear high yield and think of bonds, not stocks. High-yield bond funds, the junk bonds, pay around 7%. That sounds incredible next to a boring bond index. But that 7% comes with very real default risk attached. These are loans to companies with shaky credit ratings. The higher the risk of default, the higher the yield they must offer. In good times, you collect the fat coupon and feel smart. In a recession, defaults spike and prices fall hard together. The average junk bond default loss runs about 1% yearly. In a downturn, that number can multiply several times over fast. So the high yield is not a gift from anyone. It is payment for taking a risk most people don't see. The market is not being generous with you. It is paying you to absorb danger quietly. Once again, the big yield number is hiding the real story underneath. The fee that looks tiny and isn't. There is one more quiet drag worth naming clearly. Many high yield and income funds charge noticeably higher fees. A boring index fund might cost 0.03% a year. Some flashy income products charge 10 or 20 times that. That fee comes out of your return every single year, silently. 0.5% a year may sound like rounding error nothing, but over 30 years, 0.5% can erase 6 figures. The fee compounds against you the same way returns compound for you. The boring fund wins partly by simply costing almost nothing. John never noticed the fee because the dividend distracted him completely. The number that felt good hid 3 numbers that quietly hurt: lower growth, higher taxes, and a fatter fee, all at once. The psychology of the paycheck. So why do smart people keep choosing the worst fund? Because the dividend feels safe and concrete and real. Seeing cash arrive scratches a deep psychological itch. Growth on a screen feels fake until you sell it. A dividend feels like a paycheck you earned. That feeling is exactly what the marketing is selling you. Passive income. Get paid to wait. Let your money work. It all sounds wonderful, and it all targets your emotions, but your emotions are a terrible portfolio manager. The market does not pay extra for what feels comfortable. It often pays more to those who tolerate the boring path. John bought a feeling, Carla bought a result. And the result quietly beat the feeling for 10 straight years. Watch what happens to $500 a month. Most people don't invest a lump sum at all. They invest a little bit every single paycheck. So let's run that version, because it's more real. Say both John and Carla add $500 monthly. Same contribution, same decade, same steady discipline as before. At the boring fund's return, Carla's monthly habit compounds beautifully. Over 10 years, she contributes $60,000 total. That $60,000 grows to roughly $140,000. At the high-yield fund's slower return, John contributes the same $60,000. But his pile grows to only about $125,000, a $15,000 gap just from steady monthly investing. And John paid more tax along the way collecting dividends. The boring habit quietly outran the exciting one again. Now stretch that same habit across a 30-year career. The gap balloons from thousands into the hundreds of thousands. Small differences, repeated monthly, decide who retires comfortable. The dividend cut nobody budgets for. Here's a risk dividend lovers rarely think about. A dividend is a promise, not a guarantee. Companies cut dividends whenever times get hard enough. In recessions, dividend cuts come in painful waves. The exact moment you need that income most, it shrinks. Imagine retiring on a fund yielding 4%. Then a downturn hits and the fund slashes its payout. Now your reliable income just dropped by a third overnight. And the share price usually drops right alongside it, so you lose income and capital at the same time. The index fund makes no income promise to break. It just owns thousands of companies and keeps compounding. You were never depending on one fragile payout. A promise that can vanish is not the safety people imagine. Volatility, the hidden tax on your nerves. People say dividend funds are safer, and sometimes that's true. But safer and more money are two different things. Lower volatility feels calmer in the short run. Over decades, though, the calmer fund left money on the table. The S&P 500 was bumpier year to year, yes. It dropped harder in scary moments more than once, but it recovered higher and climbed further every time. The investor who could stomach the bumps got rewarded. The real risk was never the volatility itself. The real risk was selling during the scary parts. If a smoother ride keeps you invested, that has value. But don't confuse a comfortable ride with a richer destination, what the last 15 years actually showed. Let's zoom out beyond just our two investors. This is not a one-year fluke or cherry-picked window. Over the past 15 years, the broad index crushed it. Big technology companies drove enormous capital appreciation. Names like Apple, Microsoft, and Nvidia did the heavy lifting. Dividend funds usually own less of that explosive growth. They favor older, slower, mature, dividend-paying businesses. Those companies are stable, but they rarely double in a few years. So the income funds collected steady checks and missed the rockets. The index simply owned the rockets automatically. It didn't have to predict the winners in advance. It just held everything and let the market sort it out. That is the quiet, unglamorous superpower of indexing. A quick word on the right account. Here's a nuance that changes the whole game. Where you hold the fund matters enormously. In a Roth or a 401k, dividends aren't taxed yearly, so the tax drag problem mostly disappears inside those accounts. That's actually the smart place for a high-yield fund. Hide the taxable income inside a tax-sheltered account. John's real mistake was holding it in a taxable brokerage. He took a forced taxable income he didn't even need. Carla's growth fund was tax efficient anywhere she put it, so the lesson isn't just which fund, but which account. Right fund, wrong account is its own expensive error. The myth that dividends fund retirement for free. Retirees love the idea of living off dividends only. Never touch the principal, just spend the income. It sounds safe, almost magical, and very tempting. But a 4% dividend and a 4% withdrawal are nearly identical. One sells nothing, one sells a few shares. Both pull the same amount out of your wealth. The dividend just hides the withdrawal from your eyes. You feel like you're spending income, not your capital. The math says they are basically the same drawdown. Total return investing simply makes that drawdown visible and flexible. The dividend approach makes it automatic and rigid instead. Same money leaving, very different control over it. Don't pay a growth penalty for a comforting illusion. 3 numbers that decide everything. Let's lock in the 3 numbers that decide everything. Number 1, total return, not yield. That is how much your money actually grew. Number 2, taxes, because forced dividends get taxed yearly. Number 3, fees, the silent drag on every dollar. John lost on all 3 without ever noticing. Higher yield, higher taxes, higher fees, lower growth. Carla won on all 3 by doing nothing fancy. She owned the whole market and let it compound. Those 3 numbers beat any yield on any screen. Memorize them before you ever buy a single fund. Yield is the headline. These 3 are the real story. Get them right and the fund almost picks itself. When the boring fund actually loses. Now let's keep it honest, because this part really matters. The index fund does not win in every single scenario. This is not religion, it is just math with context. If you are retired and need steady cash flow right now, dividends help a lot. They give you income without forcing you to sell in a downturn. Selling shares in a crash to eat is genuinely painful. A dividend keeps paying even when prices are falling. For some retirees, that predictability is genuinely worth a little less growth. And in a flat or falling market, dividend funds often hold up better. They are usually less volatile and less terrifying to actually hold. A calmer ride sometimes keeps people invested when they'd otherwise panic. So the high-yield fund is not evil or stupid at all. It is a tool, and tools fit specific jobs and seasons. The mistake is using a retirement income tool during your growth years. Right tool, right job, wrong decade is the whole problem. So here is the twist almost nobody sees coming. The high-yield fund did not lose because dividends are bad. It lost because John picked it for the entirely wrong reason. He chose a fund based on one number on a screen. He never once asked whether that number fit his actual life. He was 42 with 20 years of growth ahead of him. He needed compounding, and he bought income he didn't need yet. He optimized for a paycheck 2 decades too early. Carla didn't win because she was smarter or braver than him. She won because she ignored the seductive number completely. She bought total return and let boring do the heavy lifting. She let time and growth quietly stack up untouched. Here's the line worth remembering for the rest of your life. The best fund is almost never the one with the highest yield on the screen. The yield is the bait. The total return is the catch. And here's the deeper layer that most videos skip entirely. Both funds can be the right answer for the right person. The growth investor needs the index fund and its quiet compounding. The retiree drawing income might genuinely prefer the dividend cash. The fund was never really the decision at all. Your stage of life was the real decision all along. John didn't pick the wrong fund in some absolute sense. He picked the right tool at exactly the wrong time. And that is the mistake hiding in millions of portfolios right now. People chasing retirement income 20 years before they retire. The number felt like winning, so they never questioned it once. They optimized the feeling and lost the fortune. Run the numbers, and the comfortable feeling falls apart fast. So before you pick a fund based on its juicy yield, stop. Ask one question that cuts through every sales pitch out there. Not what does it pay me every quarter. Ask what is the total return after taxes and fees. Then ask whether you need income now or growth for later. If you are decades from retirement, growth almost always wins. If you are living off the portfolio today, income earns its place. Match the tool to your stage, not to your feelings. The yield on the screen is built to grab you. Total return after taxes and fees is the only score that counts. The fund that feels exciting is rarely the fund that builds wealth. And the boring fund you keep ignoring is often quietly winning. If this showed you something you didn't know about your money, subscribe to Wealth Logic and hit the notification bell. We break down the hidden math behind the financial decisions you face every day. Make the decision that matches your reality, not someone else's sales pitch. Because in the end, the boring choice is usually the rich one.